Hello, everyone. Welcome to our January 2017 Ticker Talk. So, Happy New Year to everyone. It's our first Ticker Talk of the new year, and that's a little bit of our theme for tonight, I will say. Tonight, we have a smaller than usual panel, but a very good one. Very good one, I will say, because Mr. Ken Kavula is here joining me, president of the Mid-Michigan chapter, volunteer extraordinaire is what I like to call him, excellent teacher, and my good friend and compatriot in this Ticker Talk. Welcome back, Ken.
Thank you, Ann. We made it to a new year.
We did. That's always a good thing. My name is Ann Cunez. I am the manager of the education programs at Better Investing. And very quickly, we always have this disclaimer. We will be mentioning stocks tonight, and we have to remind you that everything is for informational purposes only, educational purposes only, I should say. We're never making any recommendations to buy, hold, or sell any securities. We own some of the securities we're going to talk about tonight, I happen to know, but we aren't doing any kind of promotion because of that. We may be featuring some various website images, products, services not necessarily endorsed in this webinar, and mentioning them is not a formal endorsement. As always, we record these sessions and they're available on the TickerTalk webpage for you to review after this session is complete. So, it is the season, right, to make those New Year's resolutions, and we thought we would provide a few tips, some help for those of you that may have set a goal to maybe be doing a better job when you're looking at your portfolio, tracking the stocks, tracking your portfolio. So we're going to begin tonight's program looking at some tips on keeping our portfolios and our SSGs up to date. First, we'll take a look at some of the signals that we use that will help us know when it's time to do a more thorough review on a stock. And then next, we're going to outline a process and discuss some of the things that are involved in doing that more thorough review. And since we're in a new year, we did think it would be a little bit fun to take a look back at some of our previous 5 and 5 selections. And I will say that's going to include some of the good, the bad, and a little bit of the ugly in that. So it'll be a fun session. And finally, as always, we'll leave you with 5 stock ideas that you may find interesting. So with that, Ken, why don't you get us started with our program tonight?
Well, that's great. We have slides available for everybody to download under the Downloads section, and you can tell your friends that these same slides will be available on the TickerTalk website in a couple of days. They're going to review the talking points that we're under today, and if you'll transfer the screen to me, thank you. What I'm going to do tonight, my part of the first part of this program, is to talk about a New Year's resolution that I would hope that many of you could make to yourself and then try to keep during this year, and that's to find a method, a cohesive method to manage your stocks and to review your stocks on a regular basis and to take a look at them in your portfolio. I do this on a once-a-month basis. It's a really quick process, and let me show you exactly how I go about putting that process together. I'm in the tool right here, and I'm using the Model Club from Mid-Michigan. I'm using the Model Club portfolio because we're used to putting that in front of an audience. So the first thing I'm doing is I'm clicking this Model Club portfolio, and it has opened down beneath right here with the stocks that happen to be in the Model Club. Now, one of the things I want are SSGs for all the stocks that I own. This happens to be a 14 stock portfolio. I want those SSGs to have the most recent quarterly data, and I want those SSGs to have the most recent price. And what's overlooked in these portfolios in the online tools many times is this button next to the portfolio name. It's on the extreme left next to the portfolio name, and when I click it, it allows me to either update just the prices within the portfolio or update to the most recent quarter and the prices within the portfolio. If I were to click OK, and I've done that already, then the updating process would begin. It wouldn't take me very long to get that done, but since I've already done it, let's move down to these stocks right here. One thing that I like to do is I like to go through my portfolio, and I like to go through it in alphabetical order because that kind of helps me remember where the last stock I was looking at and what's the next one I'm going to want to take up. So if I click at the very top of the column, I alphabetize the stocks in the portfolio, and again, there's 14 stocks right here. My process would be to go through each of these 14 stocks. It would take me about a half an hour to do that, and on each one of the stocks, I would be evaluating it, looking for either everything going well or looking for specific reasons why I might want to take a deep dive into that stock on this particular month. I would like to go through all of my stocks 2, 3, 4 times during the year, and that means that each month I'm going to want to review 2, maybe 3, maybe 4 of my stocks. So as I go through these one by one, I'm going to just keep a piece of paper next to my computer here, and I'm going to jot down those that are of immediate concern and need an immediate look. I'm going to jot down those that might need an immediate look, and I'm going to jot down those that are safe. I'm hoping that when I finish, I'll have 2 or 3 or maybe 4 to take a real look at. So let me show you how I do the process. Remember, it's a short process. For the 14 stocks, I wouldn't spend more than a half an hour going through it real quickly to identify the stocks that need a deep review. So I just start with the first one, and it happens to be Air Lease in our portfolio. And the first thing I do is I look at the visual analysis. Is the most recent quarter that's fallen in, is it on trend? And in this case, it is. Then I go over and I look at the EPS long-term forecast from the analyst community. This number is supplied to us by Morningstar, and I notice that it's 15% EPS growth, and I'm looking down on my SSG, and my SSG, my judgment, is 14% EPS growth. I'm very happy with the fact that those two numbers are relatively close together. Remember, my judgment won't change month to month unless I choose to change it, but these numbers under the analyst numbers might very well change on a monthly basis depending on what the analyst community is deciding about the stock. So far, nothing to force me into a review of this company. I'm turning the SSG over. Before I do that, let me remark that Section 2 of the SSG only changes on the end of a fiscal year. So it's not necessary during the fiscal year to review those numbers yet again. So here I am now going to the back side. Let me also remind you that most of the information on this grid does not change except on a yearly basis, but there are a couple of places that you might want to check. I always like to see, is my stock trading at near the bottom or near the top or near the middle, and I notice that Air Lease is trading near the top of its 52-week range. I also like to look at its current PE ratio. Notice it's around 10 or 11 there, and I like to compare it to the 5-year average. I've eliminated the 2011 data because I don't feel it represents the averages or the numbers very well. So I'm looking at a 4-year average here, and it's considerably higher than this ratio right here. Nothing to concern me so far. The stock might be a nice buy when its PE is this much lower than its 4-year average. The last place I take a real quick look is at the upside-downside ratio. It's on this little chart right here, or of course it's in the body of the SSG as well, and the upside-downside is 5.4 to 1. I want to make sure that my upside downside does not fall significantly under 1 to 1, because that's a trigger for further research as well. When it moves down around 7/10 to 1 or 8/10 to 1, that's a reason that I would put this stock on my to review list. The very last place I look is clicking in the low price right here, and I want to make sure that my last 4 quarters matches the number that I've chosen in 4BA. I will remind most of you that that's the choice I make 95% of the time for my analysis, and I want to make sure that I have the most recent trailing 12 months sitting in that box. I then move all the way down to the bottom of the SSG and I check the return. If the return is getting significantly small, that might be reason for review as well. So if my total return is moving down around 4 or 5%, or my par value moving down and approaching 0, those are values that would trigger a review of the stock. It might be telling me that this stock is overvalued and I should consider selling all or part of it to preserve some of my capital. That's the kind of review I put together for all 14 stocks, and believe me, it takes me longer to explain what I do than to actually look at what I do. I'm going to step back rather than use the Navigate tab because I wanted to get back to the portfolio right here.
Yeah,
and
Ken,
I'm going to take,
before
go on,
you,
Ann, sure.
There's a question, and you can handle it real quickly. Somebody is asking how you got to that portfolio section of that screen, of that study screen.
Sure.
Yeah.
Over on the side of the tool, you'll see some tabs, and there's a green tab called My Studies. And if you click on My Studies, what will open up is a window with all of your stock studies at the bottom of the page, but at the top of the page, if you've created portfolios, then those portfolios can be accessed on the top. And by clicking on the name of the portfolio, then just the studies in the portfolio end up on the display at the bottom at that point then. Does that help a little bit, Ann?
And if I can add just one more quick step, you need, originally the portfolio window is collapsed. So you do have to click on that large bar that says portfolios. No, right? You've already done it.
I was moving my taskbar. Okay, right here, right there, you click on portfolios.
And that will expand the portfolios. But you do have to have portfolios created. And if you don't, we have some other webinars that we will direct you to. But hopefully that helps.
I've also found that if I've been working with a portfolio recently and then come back into the tool, the portfolios are open. So if it's not open, click on portfolios and it'll open right up.
Thanks for doing that.
So let's go to Buffalo Wild Wings, which is the second one. And again, I'm looking for reasons why I might want to review this stock. So I did a double click, and here comes Buffalo Wild Wings for me to take a look at. And I'm looking at the dots, and they appear to be on trend. So I'm not too concerned about the most recent quarter falling in. Here I am looking at the current price. You see that little red tick on the price bar? And Buffalo Wild Wings is trading in the middle of its trading range. That doesn't concern me a whole lot. So I'm looking over here at the EPS long-term trend. This is a 5-year estimate coming from Morningstar, and they're telling me 19%. So I'm comparing it to my judgment, and my judgment is only 12.6%. So that's a considerable difference. And so that's one thing that might put Buffalo Wild Wings on the list to be reviewed. Now, I keep a notebook. It's a legacy from when I was investing before computers, and I would take any notes about my investment and keep them there, and then update them on an every quarterly basis, sometimes every 6 months basis, and I still do that today. There are electronic ways to keep these notes, but I just have fallen into the habit of this notebook. I'm on my 6th or 7th one now, and so I would make a note last month if that difference between the analysts and my judgment would have been that far apart. And last month they were not that far apart. So the analyst community has become a little bit more optimistic about that company, and that might be a reason why I want to review this company after this data that's coming in right here. I'm looking at the back. Remember, Section 2 is not new. There's very little new here in Section 3, but I am looking at the current PE of around 26.5, and I'm comparing it to the annual 5-year average, in this case, of 28.5. Again, maybe there's an opportunity for a purchase right there. We're under the 5-year historic average. I'm looking at the upside downside. It's certainly not under 1-to-1. It's not down around 0.7 or 0.8, so that would not trigger a review. So, and I'm looking at the returns, and they are not down around 5% or less. So I would put on my list to the side. Remember, I said Air Lease, don't worry about it. Now Buffalo Wild Wings, I would put a maybe. There is a good reason to trigger a review, and if I don't see 2 or 3 other companies in my portfolio, then in fact I would review this one. Let's move back, and I'm going to show you one more just for example's sake. Now I would go through these one at a time, each time assigning the label of no or maybe or yes review to them. And here I'm on the last one now, Visa, and I'm pulling up Visa because it presents an interesting problem as well. I'm looking at the most recent data, and immediately I notice that the new fiscal year has fallen in. I checked my notes, and by goodness, it was not there a little bit ago. Last month when I looked, that piece of data wasn't there. So that's going to trigger a review of Visa, and so I checked my notes. Do I know anything that happened during the year with Visa that might cause this downturn in earnings? And I don't have to look back very far. On the third quarter, when I was doing this review, I actually reviewed this company. I did it 2 months ago, and when I reviewed this company, I found out that the company had taken a significant charge for the purchase of Visa Europe. So the third quarter earnings number was significantly below trend, and that's what's driving down this whole year number to be slightly below trend. So I am going to review Visa. I'm putting it as a strong maybe or a weak yes, because it is the end of the fiscal year, and I want to make sure to review all my stocks at least twice a year, and that means once at the end of the fiscal year and then one other time at least. So Visa would go on my maybe list. Notice that a lot of the other things also might be indicating that there's a reason to take a look. Here's that ACE number at around 16. Here's my judgment around 10, and that's a significant difference. A good reason to review. This time, these numbers are all new. I do notice that there's a drop in profit margin. I do notice that there's a fairly decent return on equity and a significant increase in debt. I think I have the answers to why those numbers are doing what they're doing. I'm looking in section 3. Notice that I've decided that the numbers in 2012 are not indicative of what's going on in my chart right here. Here's my current PE of 33. Here's my average PE of 25. And since I've been doing this for a long time, I know that that charge, which lowers the earnings per share for the year, will raise the PE. Remember, the PE is a ratio. It's a fraction. And when the denominator, when the bottom of a fraction gets larger, the fraction gets smaller. And when the denominator gets smaller, the fraction gets larger. Think of the fraction 1/8 and 1/3. There's the denominator getting smaller and the value of the fraction getting larger. So I'm explaining this outsized PE right here, and I'm again looking back on that one-time charge for the purchase of Visa Europe. It was a significant charge and has a significant impact on what's happening with the company. I'm also taking a look at my upside downside right here, and it's a little bit low, and I have to remind myself that it's low because of that one-time charge sitting within those numbers. Now, when I finish my review for Visa, I probably will be adjusting that most recent fiscal year number, and I'm starting to step a little bit on Ann's toes, so we'll wait, and she's going to show us how you would make an adjustment for a number. Again, this is a fairly short process that I use. Takes about 2 or 3 minutes per stock. I end up with a list of 2 or 3, maybe 4 stocks out of my 14 to take a deeper look, and my deeper look would probably be somewhere between 45 minutes and an hour for that stock spread over the rest of the month. So you can see that I'm not spending an inordinate amount of time reviewing my stocks, but I am keeping up to date, and as problems occur, as different things happen, I'm going to factor them into my judgments, and therefore I hope I'll have better SSGs, which will lead me to better buys and sells. Ann, why don't we move to your topic now, okay? Hello, Ann?
I'm sorry. I asked an entire question, and you didn't hear that. So let me try that again.
Okay, yes.
So the question is there anything on the high side that would, on an upside-downside ratio, that might force you or trigger a full review on a stock? Or is it just on the low side?
It wouldn't necessarily trigger a review, but it would certainly play into the possibility of a review, and that would be if my upside downside moved into the low teens or the mid-teens. If it moved there, that might be an indicator that my SSG is a little bit too aggressive. I've been doing SSGs for a long time, and that's a problem that I very rarely have. When I do find a problem like that with really, really high upside downsides, I find that it's a function of the economy rather than of the specific company, and I find it happening on many of my SSGs rather than just on a single one.
Okay, great. I'm going to take the screen back here because we're going to move back and look at, continue looking at this. So Ken led us through a really nice process. We update our portfolio. We've selected a few stocks that may need a thorough review. So now what? Well, how you proceed with this really has a lot to do with the reasons that the review was triggered. Why was it put on the list to begin with? For example, if your review is just triggered because a new fiscal year piece of data fell into place, but everything appears to be on trend, I would probably follow the general outline that we're going to talk about in the next couple of slides. On the other hand, if you're seeing something on the graph, some disturbance you're observing, something that is looking quite irregular, and that's what triggered it, then you're going to want to dig into that information specifically about that quarter, learn about what was going on, similar to what Ken was talking about with the visa situation. And you may or may not want to review all the steps that we're going to talk about. In any case, always make sure your data is current. We're going to keep hitting that point. If it's been a few days since you put it on the list, go ahead and update that data one more time. Make sure you're looking at fresh data and fresh prices. Also, one thing I always do is I'm going to take a moment to look at whatever existing notes I've got on my company. Excuse me. I keep computer files on all of my companies with notes and my thoughts and conclusions and that kind of thing. The format isn't important, whether you're using electronic or a piece of paper. That doesn't matter, but I do hope you're keeping some kind of notes on your portfolio. So review those so you know where you were the last time you went to look at this company. So here's some steps, a general process to review your stocks. Generally I'm going to start with reading some analyst reports, from the standard sources if they are available. They're not available for everything. These will include things like the Morningstar Analyst Report, the Value Line Report, and an S&P report. Those are what we call our standard analyst sources. You might have some other ones that you regularly go to. These reports are available through many libraries, some brokerages will have them. If you have them available, and if there is a study, a report on your company, use it, read it. As I read through those reports, I'm going to take notes about growth rates, things that are going to affect the future growth. Next, I'm going to go to my analyst consensus estimates, and I'm going to check those from several different sources. They can vary to some extent. So I usually will check the source, the ACE numbers from Yahoo and Zacks. Those are actually two different sources of data. Ken already pointed out we have some consensus numbers from Morningstar that's included right with our data, so that's a third one that I'm going to have to check. Next, I'm going to want to look at the latest financial press release from the company, the one that discusses their most recent quarterly results or their annual results. And of course, I want to learn more about, how did they do, what went well, maybe what challenges they faced, what problems they faced. And as I read that press release, I'm also looking for any forecasts or maybe goals the company has set for their future growth. These are often very, very short term. If you've seen them, they might be only for the next quarter, maybe the next 2 quarters. But that's okay. I still want this information to just make sure that my own forecasts are close to what the company is working towards. I want to make sure we're in line with each other. Another item I look for in the press release is if the company is reporting any special charges or unusual expenses that had an effect on the company performance. I'm going to take a look at this information, maybe determine whether or not a data adjustment might be merited on the SSG. And actually, we do have an example coming up, so I'm going to leave a lot of that discussion for that. Pretty much everything you're going to need to make that evaluation will be right in the press release, but if you're still looking for more detail, you can always go to the associated 10Q quarterly report or the 10K, the SEC filings. Next, I'm going to want to take a look at news reports about the company. And here is where I'm going to caution you to really focus on real news, news that will have some kind of a material effect on the future performance and operations of the company. I'm not interested in the noise, and these would include things like I mentioned here, analyst upgrades and downgrades, you know, news about class action lawsuits, or even press releases from the company themselves. They can look very official, but sometimes they're just more advertising about their products or services or whatever than solid news about the company operations. And one more little warning, you know your sources. Understand where your data is coming from. You know, there's plenty of fake news stories out there. Sometimes they're written by someone that has a real direct interest in making the stock move up or down. So be careful. You know, sponsored news is another problem. You know, I know in my Yahoo news feed now I'm getting something that looks like a news story, but in reality it's just some kind of an ad. You know, basically if I don't recognize and respect the source of the news item, I tend to just skip it. You know, once I've gone through that process and read through that data, I'm going to want to evaluate it and make a determination if there's any changes I need to make on my SSG. You know, typically my growth estimates could be changed during the course of the fiscal year, but for me it's actually rare to do that, and it would be dependent on there being some big fundamental change in the operations of the company. Or maybe there's a shift in the general economy, you know, a ramping up or a slowing down or something like that. But generally, I'm making my changes at the end of the year when I have the most new information about the company available. Same goes for PEs. I rarely change those mid-year because I just really don't have any more information until that next fiscal year piece of data is added. You know, there is an exception probably to that. The extreme market conditions like what we saw in 2008 and 2009, that could be an exception, a catalyst to change those midstream, but truly that's the exception and not the rule. Finally, once I've made, you know, done my evaluation, simply make your changes. Change your SSG, or if you're talking to your club, make your recommendations. And this is really important, log your reasons in your document. Put your conclusions in there so that you have that to refer to the next time you go to update your stock. It'll refresh your memory. I don't know about you, but my memory is not so great now, and I depend on these documents to remind me what I was thinking about the stock at that time. And this is just another little note. Even if you've decided no change is necessary, realize that's a decision and log that conclusion as well, maybe with some of your reasons as to why you maintained the existing judgments. So next we're going to take a little bit of a case study here. I'm going to review Priceline. I do own this stock. And this is a process that I recently followed. I'm the stock watcher. I updated the stock, and I'm going to go through the process with you. This third quarter earnings per share, you see everything's kind of proceeding along, and what the heck happened there? That's all I needed to see to trigger in my mind it's time to do another review. So let us bring over a live copy of my Priceline. So the first thing, remember what we want to do? We want to make sure that we're looking at up-to-date data. Very easy to do. Just hit data, refresh study data, overwrite the company data and stock closing prices. I've already done this, but I'll do it again. It's just that fast. Now I know that I have the most up-to-date data that I'm looking at, including the prices for my stock study. Okay, so as you see, that's a problem, that earnings per share. You can look over here in the box and you can see that it's down about 57%. I want to know what happened. I'm also observing that my sales is continuing to be on trend. So, and also look at my price bars here. Ken, maybe, are you unmuted? I'm getting a little bit of background noise. So if you could, thank you, sir. Appreciate it. Price bars. So price bars, I'm also noticing are the price is not dropping. This is the 52-week high and low price with our I bar here identifying the low and the high and our red tick mark indicating the current price. So whatever happened here did not spook the market, did not scare off any investors because they're still bidding this company up near a 52-week high. If we just take a real quick look at the back side, we can see that low earnings per share, Ken talked about that in the case of Visa, that's affecting our PE very, very high at 39. This has my judgments. This is my club SSG, and I'm seeing all of a sudden Priceline's only a 0.7 to 1 and only a 5% total return expected. That's not where we were in the previous quarter. So what do? Well, I'm going to look for a special charge. When I see patterns like this, this tells me there's some kind of special charge in this earnings that happened, and I want to learn what it was for. The way I'm going to do that is I'm going to go to that recent press release, that quarterly press release where they're going to report about their earnings. And you can find those on the company website, other places. The place I like to go and find them is under filings and transcripts. I like to go right to the SEC filings. I click on all because actually the filing I'm looking for is known as an 8K. An 8K is a press release that has information that's important to investors, basically. It's a press release that has important information. So I'm going to filter, and I've done it earlier, so it's already there. I'm going to filter by 8K, and now I just have 8Ks, and there's still a lot of them, you see here. It's like, which one do you know what to do, which one to use? Well, remember, we were looking at the third quarter. That ended 9/30/2016. I know that it takes them about a month, a little bit longer, to get out their reports. So I'm looking for something at the beginning of November, something like that. Here's another tip. Look for items 2.02 and 9.01. That's basically a code. That means that they're reporting the results of operations and a financial statement is included in that report. This is the one I'm looking for. I'm going to click on Documents, and I'm going to be able to open up that press release. Well, I've actually got that here in the PowerPoint, and I want to go back to that because I've got some stuff highlighted. So here we are. This is the actual press release. I don't have to read very far at all to learn that the reason for the third quarter earnings being so low is that they were negatively impacted by this non-cash charge, $941 million non-cash charge relating to the impairment of OpenTable's goodwill. Priceline did acquire OpenTable a couple years ago in 2014. Apparently things didn't go quite according to their plans, and so they are writing down the value of this goodwill account that they have. There's lots of words that they talk about and reasons. Basically, when I see something like this, I just determine that Priceline overpaid for the acquisition. They're recognizing that mistake and adjusting their financials accordingly. While that's not necessarily a good thing, it doesn't really reflect well on their management decision regarding how much to pay for the acquisition. I am willing to discount this kind of a charge as it really isn't part of the normal operations of the company. So, how do I make that adjustment? Well, I look for a table in the press release that will help me reconcile what's known as the GAAP, the Generally Accepted Accounting Principles, to a non-GAAP number. The income statement is reported per GAAP following these rules, and those rules say that goodwill impairment charge is part of the income statement. Well, here they're presenting a number of adjustments that they say, well, these aren't really important, and we want you to consider these other numbers. There's that impairment charge, very large number compared to all these other items that they're taking off here. So what I want to do is I want to add that back in to this net income number, which is what I did. So I add that back in, and I divided that by the number of shares outstanding. Now, that's not really a complete analysis. I wasn't sure how to adjust the taxes for all of that. So when I came up with my number of $28.95, I just bumped that down a bit, maybe $1 per share, to account for any miscalculations I'm making regarding the taxes, and I was okay with that. I'm not so concerned with getting precise values to the penny. I just want to get a sense of what the EPS would have been without that impairment charge. And I hope that is making sense. Now, I will point out that, look at, Priceline is giving us a non-GAAP number of their own, $31.18. And if you wanted to use that, that would be a fairly reasonable thing to do. But since there are other items that I don't think are so important to take out, and Priceline is telling me that I should, I don't necessarily agree. I just went with my more conservative analysis and left it at the $28. Okay, so that's how I figured out what the number was that I wanted to use. Let's go back to our SSG and make that adjustment. So notice right now we're at $10.13. When we're projecting our earnings out from this figure, we're ending up with close to $79 future earnings. Well, I'm going to change that. I'm hovering here over the data menu item. Quarterly data is what I select. And I pick, and okay, here we go. And you just have to click in the cell that you're concerned with. So it's the most recent quarter, the earnings per share number, and I'm going to change that $10.13 to $28. Okay, simple as that. I'm going to update my study. Oh, and notice what happened here to this letter. As soon as I typed a new letter, a new value in there, that tells me that the status of this line item is that it's user modified. So at a glance, you can see whether it's final data, preliminary, that's something else that comes from Morningstar, or if you, the user, has modified that. So I see that reflected there. I'm going to close this box. Here now, I have my earnings back on trend with my $28 that I most recently put in here. With a year over year, assuming the 28, I don't have a 57% drop any longer. I have a 19% increase. So that just gives me a little bit better idea of how this company is going to perform going forward. Look what happened to our future earnings per share 5 years out in the future. I'm projecting from the most recent data point from the most recent quarter. We went from, what did I say it was before, $79 or something like that, up to $114. Well, that's going to make a tremendous difference when we look at the back side of our SSG. Look at our current PE now. That elevated because now we have an adjusted trailing 12 months earnings per share. My high price got adjusted upward. My upside-downside ratio also increased accordingly, back to a 2.1 or so, with my returns being somewhere between 9 and 13%. That gives me a really good sense of what this company is doing as based on the operations of the company and taking out that one-time charge. I was comfortable doing that in this case, given what it is and given Priceline's history in that this is a fairly rare occurrence. I might not have said that previously, but that's also important. If you see a company that's regularly taking these adjustments and these write-offs, it's not so special any longer. So that's just kind of a case study. At this point, you could decide to go on and do all the rest of the research that we talked about, or not. But since my head is in the game, and actually it was in the game, I did go ahead and pull everything I knew, and so probably when my fiscal year numbers come in, I'll have a little bit easier time understanding things going forward. So that really completes our tips for keeping your portfolio and your SSGs up to date. It's, not a real precise schedule that we sent you with, but hopefully gives you some ideas that you can use for your own stock studies going forward. So our next... Yeah, go ahead.
If we're not using a notebook like I use, can you show folks real quickly where they might keep some notes about the changes they make?
I have my notes right here in front of me, but of course I don't read them. Okay, so yes, excellent point. And I saw that there was a question earlier about that. So I do use the notes feature for things like this. Under Tools, look at where my cursor is. I'm hovering over the menu item Tools and Notes. This is so important, especially when you're making an adjustment. What happened to my notes? Oh dear. I might have messed these up. I did. My notes are gone. All right. Typically, I had a whole list of them. I can't believe that happened. I didn't start a new study. I'm a little confused as far as why that happened, but it's probably user error, undoubtedly. Can I just show you real quick? And God help me if they're gone from here. So I'm going to show you my actual club one, so I can go to the notes and look at. See, I didn't lie. I use these all the time. And specifically when I was talking about this third quarter adjustment, you're really going to want to make sure that you make a note of what your adjustment was, because when you do update that data the next time, your user data will be gone and you will have to put that in. It doesn't take long to put it in, but you'll definitely want to remember, and I just put that note in there for any time I make an adjustment. So, sorry about that confusion. I don't know what happened on those other ones, but that's the Notes feature in Tools and Notes. Anything else, Ken, that I can confuse people about?
We have a couple of folks that want to know if that overwrite of the data will stay when you update the SSG.
Okay, so the data, and actually I think I can go here because I did the exact same thing for my club one, is the answer is no. When you update this data, so when I refresh this stock data, that's pulling in all the data from Morningstar, and it's going to wipe out your special changes. Now, I cannot talk about timelines because we're not really close, but I know one of the next features we are working on in the tools is the ability to lock data, and the ability to lock data on a particular line item. So if I have a user entered piece of data here, there's going to be some kind of a little lock mechanism that I could say lock that and don't change that the next time I do an automatic input. It's not around the corner, it's not right now, but it is one of the very top of the list next things that we're working on. So, a little preview. All right. We're coming back to you, Ken, or you're going to talk a little bit about a little bit of that fun part where we're going to take a look back at some of our 5 and 5 stock picks.
Well, I always find it interesting, Ann, to just look back at what we've been telling people and the kind of companies we've been looking at. And here I am just looking back 1 year. And, I'm looking at some pretty hefty gains in some of the stocks that we've mentioned in TickerTalk over the last 12 months. Now, remember that we're not making recommendations and we're not creating a portfolio. We're just giving you some ideas to take a look at. But here's 10 months, 10 issues, 10 ideas that gained around 25% or better over a 1 year, actually less than 1 year period. There's some really interesting names on that list, and I think some of the names on this list are still interesting going forward. So I just like to kind of look back and see how well some of the things are doing. I don't want anybody to have the idea that all we do is pick winners, so I have also included the 3 worst picks that we made last year. I made 2 of them and Ann made 1 of them. And they just were not very good picks. That Novo Nordisk I still think is a wonderful company, but it's been caught up in the biotech atmosphere of pricing and who's going to charge what for what, and it's been tarred with the same brush, even though Novo Nordisk doesn't seem to have the pricing problems some of the other companies have. Let's click again, Ann.
Yeah, before we go that, I want to ask people to go ahead and look at this G3 that I mentioned about a year ago, and you'll find why it's so important to keep an update on your SSGs. That's just a little clue as far as why it's down 34%.
Here we are looking back about 3 years now, looking back to 2014, somewhere between 2 and 3 years. And again, we have some pretty great returns, 40% plus, all the way up to more than 100% appreciation over 2 years. And again, there are some great companies on this list of winners, and there are some companies that I really think you could look at today, and you still might consider some of them to be a buy. And again, just to keep perspective, not only do we make some pretty good stock picks, but occasionally we make some boneheaded picks as well. So there we are, picking Oceaneering International. Since 2011, I think we've picked that company 3 times. It's in the oil patch. It deals with deep shore drilling, and it's just been savaged by the market over the time we've looked at it. The other 2 companies just have some real flaws in their business model right now, and you want to go to the SSG and you want to see if the SSG will show you the time when these companies were good growth companies, and then, just like on G3 Apparel, when they started to fall apart. The SSG will speak to you loudly and clearly when that happens. One more click, Ann.
Yeah, and just as we're starting up here, this column here with the percentages, we are simply presenting a very simple percent growth of price only. We're not really looking at dividends. I don't know, did you mention that, Ken? There's no dividend.
I was going to make a big deal of it in the next slide, in fact.
Okay, well, I'm sorry, but there's a question. So it's just the total return since we mentioned it to the current time. That's what that is.
Yeah, I will tell our audience that we had originally planned to include dividends in everything we were doing because we knew that the historical data for Yahoo Finance included a column that adjusted all of the closing prices for dividends that were paid. The only problem is that in the new updates on Yahoo Finance, that column is not working, or at least it's not working correctly. So if you're relying on that column to come up with adjusted prices, they aren't correct right now on the Yahoo Finance site. Let's go one more click. Oh, you did. And these are winners and losers from the first year that we did Ticker Talk. That was way back in 2011. And I'd love to give all my money to Pat Donnelly if Pat could guarantee me 644.93% returns on the stocks he picks. That's just an outstanding return, even to get a doubling of your money in this approximately 5-year period. And for these, we're talking 5 a little bit plus or 5 a little bit minus. But in this 5-year period approximately, you're getting some really, really great appreciation. And if you look, there's some just plain old ordinary names. You don't have to get real fancy with your investing. Stryker, for example, a company favorite, a community favorite. Stryker's been mentioned. Better investing community since the 80s when I first started investing. Look at that, 157% appreciation, and that doesn't include the dividend. The same for Apple or Microsoft, or one of my favorites on this list, good old ordinary Paychex. I've owned Paychex now for about 35 years, and it just keeps doing really ordinary, boring things. Here it is, doubling again in the 5-year period, almost exactly 5-year period, doubling, and on top of that, Paychex pays a nice, healthy dividend, which I can bank along with the 117% appreciation. And again, just to keep us humble, we do make some really bad choices as well. Ann's choice of Urban Outfitters and my choice of Quality Systems did not set us well for the 5-year period. I hope, in fact, that if you bought Quality Systems back when it was a high-class growth company in 2011, 2012, I hope that you watched your SSG as the company fell apart and that you got rid of that company. You didn't hold it as dead money up until today. It's just interesting to look at these things, and we've put them into your handouts so that you can take a look at some of these companies. And again, I think that you're going to find that some of these companies that have given you great appreciation in the last couple, 3, 4, 5 years are still maybe sitting somewhere near the buy zone or in the buy zone. It's interesting to go through and do some preliminary studies. We're going to move to our 5 in 5 right now.
Oops, I'm sorry.
That's okay.
Hold on. Hold on. I thought I had already done this, but apparently I didn't. I'm just making all kinds of technical issues tonight. So I'm going to unhide these slides. There we go. I think we're going to have them back now. Yeah, now we're moving into our 5 in 5, some stock ideas.
Well, since there's only 2 of us tonight, I'm going to start, and then we're going to do Ann, and me again. Remember that no recommendations for purchase or sale are intended. Please do your own homework, and we're going to start. I've made my picks from the list of winners that I've showed you, okay? So the first one that we're going to take a look at is Gentex. Gentex is a Michigan company, and whether you know it or not, Michigan is on the comeback trail with jobs and with unemployment coming to historic lows. And this is the kind of company out of Zeeland, Michigan, that is helping the Michigan economy get back on the right track again. Those are certainly beautiful lines, nothing at all to be particularly worried about. I'm going down to section 2 of this SSG real quickly, and I'm noticing that the profit margins are headed in the right direction. The return on equity is pretty decent. It's not stellar, but it's still pretty decent at somewhere above 15. And the debt, while it's red over there in the code, it's still well underneath our 30%. So I wouldn't worry too much about the red after I explore those numbers. And in fact, for the last year, the debt actually was moving in the right direction, which was down. Let's turn this over real quick. This company makes fancy mirrors and different kinds of parts for the automobile industry, and they're also getting quite involved in the Internet of Things, IoT. And the Internet of Things are anything that you might have in your house or in your car or on your body that can connect to the Internet. Gentex is really getting themselves involved in that particular market. I'm looking at the current PE of around 17. I'm comparing that to the 5-year average, which is very close to the 17, and I'm concluding that this company might very well be something that I would be interested in. So I offer Gentex as one of my 5 in 5s for this month.
All right, I'm going to go to a pick that was from the top performer list of 2016, and that's Alamo Group, ticker symbol ALG. I picked this stock basically out of a very simple screen last year. I didn't know anything about it. I still don't, frankly, know a ton about it. Unfortunately, I didn't buy it at that time. Darn. But when you visit the company website, which, by the way, has a ton of great information, you will see that their tagline is, "We clear the way." And when you look through the products, you know, you get a little bit of a chuckle. That's a good summary of the kind of products that they manufacture and sell. They have a number of products such as large industrial mowers, snow plows, street sweepers, also are big in the agriculture area, so they've got big moving machines that are useful in agriculture and that kind of thing. So the stock price has done really well, as we saw in our chart, as we see here on our I-bars. It's near a 52-week high, but the sales have been kind of flat. You could see they were flattening, and now they're flattening even more. Earnings per share has just fallen off this most recent quarter after being kind of on trend previous to that. I did take a quick read of the recent quarterly report to see if there was anything special in there, but mainly this earnings per share fall off is really just due to the sales fall off and nothing more. The company did indicate in their press release that they're seeing signs of improvement for 2017, but that is up to you to do your research. This is a very small company, or not very small, it's pretty small. It's $880 million, so it's under $1 billion. It has very little analyst coverage, so you're kind of on your own. It can be a little bit more challenging to evaluate this type of a stock, but it is here. The Evaluate Management section really does look pretty good with our margins being up, our return on equity numbers a little bit low but improving, you know, into the double digits, and that's a good thing. Debt, they do have some, but I am not concerned at this level of debt. Now, one of the biggest differences between this year and last year when I presented this stock is the PE. The PE currently is about 20. Last year when I presented this stock, I'm looking it up here, it was closer to 13. So it might not be the very best time to buy, but it's always a good time for a stock study, and it's a little bit interesting stock. They've got a great investor relations webpage. If it looks interesting, put it on your list of stocks to learn a little bit more about. What's your next one, Ken?
My next one is eGov. The company's name is NIC Incorporated, and eGov is a tech company. Look at those lines. I mean, if there's a poster child for Up, Straight, and Parallel, this might be in the running for that award. Notice that it, too, is trading near the top of its price range, that red tick right at the top of the I bar there. And notice that the most recent quarter has certainly been on trend, certainly been moving in the right direction. eGov is a tech company, and they build websites. They build websites mainly for the federal government in certain agencies and for state governments. And their business model is pretty unique. They'll go into a state and they'll build a free website for the state, and then they'll take a certain amount of the money that people pay to hitch into the website, and then they'll give such good service that the state will then hire them to expand that website. So they might start with the driver's license, allowing you to renew your license online, and then they might move into hunting license or fishing licenses. They might move into managing children's health or different types of health services. A real interesting business model and a great website if you take a look at it. Section 2, I have pretty decent margins. I have excellent return on equities. When I see numbers up around 20 or better, those are really good numbers. And of course, we're carrying, not of course, but we're carrying no debt. That's the reason for that nice that nice straight line on the debt right there. Let's turn it over real quickly. eGov, that's the ticker, EGOV, the name of the company again, NIC, and it's a fairly high PE company because the growth is pretty decent, but the current PE ratio is sticking really close to the average PE ratio. I would only worry for this company as the growth began to slow, and eventually the growth will slow, and with it will come shrinking PE values and slowing percentage growth numbers for both revenues and earnings. But right now we might be in a real sweet spot for the company. I would definitely take a look at it and place it on your watch list.
Okay. My next stock is Paychex. We talked about this earlier. I guess I was surprised when I looked through the list that we hadn't mentioned this actually since the one and only time it was mentioned in October of 2011. What does this company do? They provide payroll and human resources and benefits services to small and medium-sized companies. That's their niche area. And, you know, at the end of October 2011, the recession was still very fresh, somewhere in this period. Unemployment rates were still pretty high, although they were improving at that time, and that is kind of a problem for a company like Paychex. But if you fast forward to today and see what it's done since then, this is what surprised me. It's like, why haven't we mentioned this stock again? It's beautiful lines, up, straight, and parallel. Yes, we had a recession. Again, the market is a little bit expensive these days. It's hard to find things that are, quote, on sale, but this is another one that's pretty much selling at a 52-week high. The management metrics all look very, very good. Our pre-tax profits are even. Nothing wrong with that. Again, beautiful return on equity numbers, topping out at 40% in the most recent year. All of this on zero debt. There is a lot to like right there.
And can I just add a comment that many times Paychex is used as a proxy for job creation in the country?
Okay.
Yeah, that when you look at a graph of the earnings for Paychex, you're practically looking at the same graph if you look at jobs being created or jobs being lost over the years because of the clientele that it serves.
Okay. All right. Very good. So here we are flipping over to the back side again, and what do I see? Well, again, the PE has elevated above that average. Back in the day, 5 years ago when I was talking about this, the current PE was 19, and it looked to be a great opportunity. But at 28, it's not so overvalued. You might want to wait for a little bit of a pullback. Who knows? I'm not really making any kind of a recommendation here. When I talked about it 5 years ago, they had one of the big reasons I mentioned it was they had a 4.6% dividend yield, which, I thought, well, that's good while you wait for recovery. Well, right now, our dividend yield is still 3%, and in this market at this time, that is really a pretty good yield for our current situation. So here is another interesting stock that hasn't been considered in a while from our look-back pile, and you might want to take a look at it as well.
And the last stock that we're going to talk about in 5 on 5 tonight is Ulta Salon Cosmetics and Fragrances. That's quite a mouthful. Ticker is ULTA, and many of you have seen these stores pop up all around the large cities and then more recently around the smaller cities in the country. Again, there's just not much not to like about the growth that's going on in this company. It's superb, and this company has moved from a small company when I first started looking at it to just a nice moderately sized medium company now, with about $3 or $4 billion worth of revenues. I like Section 2 about Ulta. Basically, these folks sell cosmetics, and boy, do they have the teen and 20-something market nailed down shut, and they're putting spas and salons into many of their stores, and that's opening them up to a whole new clientele of 40, 50, and 60-somethings as well. So they really have worked this beauty idea to the max and seem to be doing quite well on it. Look at the debt, no debt. Look at the profit margins moving in the right directions, and really, really good return on equity, a very clean number because of the zero debt. I'm turning the thing over, and I would warn you that this is a high PE stock. This has been a high PE stock for a number of years. You're not going to get a bargain. The last time we recommended Ulta, the PE was in the mid to high 30s, and now it's moved up to around 44, 45. The 5-year average, you will note, is only at 31. So the company is priced for perfection. You might have heard that in a lot of different places if you listen to investing people talk. And if something should happen, that PE will revert to the mean, which means it'll go small real quick. And when a PE shrinks real quickly, the only way for that to happen is for the price of the stock to shrink. There is no dividend being paid, so there's no safety net. You're walking on a high wire with no safety net, but at the same time, there are great rewards to be had if the management can continue doing what it's been doing for the last 5 or 6 years.
All righty, that is a wrap. That's the tickers that we just talked about. No time to linger, because I have to invite you to our next Ticker Talk, which is coming up on Thursday, February 16th. I promise I will be getting registration information up very, very soon. On our panel, we will have Dennis Junord, who is the Director of Education at Better Investing. Ken will be back, I will be back, and I hope that you all will be back to join us. Those are our email addresses. If I see there was a flurry of questions today, I want to thank our back room. We have Joan Loken, Charles Bard, Arlene Skaggs. Again, guys, we cannot do this without you. Appreciate all of your help. And with that, Ken, thank you again, sir. It was a good night.
Very enjoyable time as usual, Ann. We'll see you next month.
All right, see you next time all. Good night.